Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. Well, trade tariff conversations seemingly are going well. Earnings season is upon us. Are we headed higher?
Well, at the start of the earnings season here, it certainly looks like it. You know, some of the trade tensions have eased a little bit, and the first initial reports that we're seeing out of the big banks, pretty positive.
Yes, JP Morgan, we saw a nice earnings report today, up about nearly 3%. Is that going to be the way earnings season is going to move forward?
Well, we've seen some lowered expectations, so we're looking for some of these big companies to really beat. JP Morgan, some of the other banks started off right on that target.
Oh, that's a great point. Well, we'll see how earnings season plays out, but let's get into this first lightning round. You ready?
All right.
S&P 500, new all-time highs. Well, it's interesting to see the equity market. Here we are back at 3,000, the EM in the S&P 500. Are we have the ability to stay above 3,000 is the question for this quarter.
Well, that's such a great question. It's going to come down to earnings, and it's going to come down to the talks with China. But, you know, an investor that might be long in the market, they may look to just collect some premium against that long position right now.
Well, that makes a lot of sense. In the event, we've seen a couple of rejections, but in the event you are a little cautious up here, maybe not believing the trade tariff conversation, what type of trading example could you utilize in this current market situation?
Right, so I'd like to sell a week 4 E-mini S&P 500 futures 3,025, 3,055 call spread, which expires on Friday, October 25th. And this spread potentially allows an investor to collect about $350.
This makes a lot of sense. The December futures contract was trading around $29.99 when this trade example was priced out, and the at-the-money volatility was 11. So in the event you do think that the market's going to pull back, this is an aggressive at-the-money, not quite at-the-money, it's about 1% out of the money, but I like that it's a little more aggressive than usual, but you also do have a larger premium to collect, Scott.
No doubt about it. Another way to look at this is potentially using micro E-mini futures, also potentially selling 5 micro E-minis, maybe starting at the 3,000 level, scaling up to 3,025.
No, that makes a lot of sense. Building that position every 5 digits higher in the E-mini S&P 500, those micro E-minis will hedge a portfolio. And if you have long exposure to the market up here, it makes a lot of sense being cautious in Q4.
Absolutely.
All right, great stuff, Scott. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
All right, let's do it.
Treasuries. Well, the Treasury's been a really interesting market. I'm fascinated to see the range we've established in the 10-year note. It's basically been 150 to 175, and here we are again, Scott, back at 175 in the yield.
Absolutely, and that range is held for quite some time, and now that we're back towards the upper end of that range, investors may be looking to take advantage of that.
Well, that's the trade example. It kind of coincides with the theme. In the event we do see the trade tariff conversations maybe dissolve a little bit, you see a little apprehension in the market, they're going to come back in and potentially buy U.S. Treasuries. So I would be a buyer of the November 10-year 131, 132 call spread. That's going to only cost about $79 because the volatility in this product is a little bit lower right now, but it expires October 25th. Scott, are we playing the range here? Is it an opportunity to see this range?
No doubt about it. And in the December futures here are trading about 129.28. And like you said, Jeff, at the money vol is down at 5.26, which makes this spread that much less expensive.
And I think we have to always be considerate of the fact that the Fed policy, that is driving the market. So the 10-year note does seem like it wants to stay under 2%, but we'll have to trust the technicals a little bit here as we approach this market.
No doubt about it. And again, you know, that range that we've been in for the last few months could continue to be there.
Well, great stuff, Scott. Thanks as always for coming on. And we also wanted to make sure you tune in every week as we'll continue to strike options.